Every investor is searching for a formula, a secret equation that promises certainty in a world of chance, a way to turn chaos into clarity, volatility into opportunity. And yet, the greatest formula in the history of investing contained no numbers at all. Benjamin Graham, the father of value investing, never promised easy answers or shortcuts. He promised clarity of thought. He showed that true investing success is not born from prediction, but from principle. Nearly a century later, investors have more information than ever. Real-time data, AI forecasts, algorithmic models, and yet more confusion than ever before. The average investor today drowns in numbers, but starves for wisdom. So what was Graham's formula? Not the one found buried in the appendix of security analysis, not the mathematical shortcut sometimes quoted by modern investors, but his real, living formula, a blueprint for rational behavior in an irrational world. It was a formula built not on calculation, but on character, a way of thinking that transformed ordinary individuals into intelligent investors. In this episode, we'll explore that formula, not as a relic of the past, but as a compass for the modern investor. We'll uncover how Graham's principles of logic, discipline, and emotional control can still guide us through markets that have changed in form, but not in nature. Because while technology has advanced, human behavior has not. And the greatest formula ever written remains the same. One that protects you not from market crashes, but from your own reactions to them. So what if the formula you've been searching for has been within your control all along? When Benjamin Graham began his career in the early 1900s, Wall Street was little more than a grand casino. Speculation, rumor, and blind optimism ruled the day. Prices moved not by analysis, but by excitement. And fortunes, vast ones, were built and destroyed almost overnight. Graham entered this world as a scholar, not a gambler. He believed that the stock market, though often irrational, could still be understood if one approached it with discipline and reason. But that belief was tested by fire. In 1929, when the Great Depression struck, Graham lost nearly 70% of his fortune. It was a humbling blow for a man of logic. He had believed in numbers, in balance sheets, in the rational power of analysis. And yet the market collapsed not under the weight of bad math, but under the weight of human emotion. Panic, greed, and fear. These invisible forces shattered even the soundest valuations. Graham realized then that intelligence alone was not enough. He needed a philosophy, a framework that could withstand not only economic downturns, but also psychological storms. And so, out of that crisis, his true formula began to take shape. A formula not for predicting markets, but for protecting oneself from them. A philosophy that could anchor the investor's mind, while the crowd drifted from euphoria to despair. He began to ask questions that were radical for his time. What if an investor's greatest advantage isn't superior information, but superior temperament? What if the true value of a stock has less to do with its price and more to do with one's patience? These questions would form the foundation of the intelligent investor, and the cornerstone of what Graham called the investor's rational framework. He separated the market into two realms, the world of the speculator, who sought excitement and quick profit, and the world of the investor, who sought safety and long-term return. To Graham, this distinction wasn't moral, it was mathematical. Because speculation, he observed, was governed by emotion, and emotion is the one variable that no formula can reliably predict.
Thus, he began to replace formulas of arithmetic with formulas of thought. The investor's chief problem, and even his worst enemy, is likely to be himself. It wasn't just about finding undervalued companies. It was about finding inner balance. Because until an investor learned to manage his emotions, no amount of financial knowledge could save him from his own impulses. This was Graham's revolution, to transform investing from an act of prediction into an act of discipline, to move from speculation to philosophy, from reaction to reason. And that, more than any equation, became his greatest contribution. At the heart of Graham's philosophy lies a deceptively simple idea that investing is not about beating others, it's about not defeating yourself. He wrote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." It was his polite way of saying that most investors lose not because the market is cruel, but because their minds are undisciplined. Graham saw that markets are not machines, they are mirrors. They reflect the collective psychology of millions of participants, their hopes, fears, overconfidence, and doubt. And within that mirror, each investor confronts not the market's madness, but their own. This is why Graham placed logic over emotion at the center of his formula. He understood that the investor who could remain rational when others were euphoric or despairing would hold the single greatest edge in all of finance. To explain this, he gave us one of the most enduring metaphors in investment history, Mr. Market. He imagined the market as a business partner who every day offers to buy your share or sell you his. But his mood swings wildly. Some days he's exuberant, offering absurdly high prices. Other days he's despondent, practically giving away his shares for pennies. The intelligent investor, Graham said, does not take Mr. Market's mood as guidance. He takes it as opportunity. He buys only when the price is far below the true value of the business and sells only when it's far above. The rest of the time, he ignores him. This wasn't merely a clever analogy, it was a blueprint for sanity. Because in every age, Mr. Market returns. He wore a bowler hat in Graham's time, he wears a smartphone today, but his voice is the same. Persuasive, emotional, and often wrong. The formula, then, is not buy low, sell high. It is think clearly, act rarely, stay calm always. Graham's method invited investors to invert their priorities. Instead of asking, "What will the market do next?" he asked, "What am I doing now and why?" He believed that an investor should anchor every decision in reasoned analysis, not in noise, not in trends, not in fear of missing out. Every purchase must rest upon what he called a sound factual basis. This approach transforms investing from a game of reaction into a practice of patience. It teaches that markets may be volatile, but value, real intrinsic value, is stable. And yet, as Graham often warned, it takes emotional courage to act rationally when the world is losing its head. That courage is what separates the intelligent investor from the speculative crowd. Because while intelligence may set the plan, it is character that executes it. Benjamin Graham was not just a philosopher of finance, he was a craftsman of logic. His genius lay in transforming abstract ideas into concrete, repeatable methods, practices any disciplined investor could follow. While the world chased tips and trends, Graham built processes. His method was not about predicting the future, it was about protecting against it. He wanted his students and his readers to see investing as a craft, rooted in analysis, guided by principle, and shielded by humility.
He began with the idea of intrinsic value, the notion that every business has a true worth independent of what the market says it's worth. A stock, to Graham, was not a ticker symbol or a price chart. It was a claim on a real enterprise. And that enterprise could be measured, studied, and valued. To determine this, he looked not at predictions of growth,
but at facts. He studied assets, earnings, dividends, and stability over time. His goal was simple: to pay far less for a company than it was reasonably worth. That difference, the cushion between price and value, was what he called the margin of safety. It is perhaps the most powerful idea in all of investing, because it turns uncertainty, which terrifies most investors, into protection. When you buy with a margin of safety, you no longer need the future to be perfect. You only need it not to be disastrous. But Graham's method went beyond numbers. He designed rules that preserved reason when emotions flared. He advised diversification not as a way to chase returns, but to defend against the unknown. He urged investors to avoid complex instruments they didn't understand, and he taught that simplicity, not sophistication, was the hallmark of intelligence. In The Intelligent Investor, he even divided investors into two archetypes: the defensive investor, who sought safety, steadiness, and minimal effort, and the enterprising investor, who pursued higher returns through deep study and discipline. Both, he said, could succeed, provided they stayed within their own nature. This was Graham's quiet insight into human psychology, that no formula, however clever, can substitute for self-knowledge. You must invest not only within your means, but within your temperament. The market, Graham wrote, is there to serve you, not instruct you, and the price of a stock should never dictate the value of your judgment. His students, like Warren Buffett, absorbed this method not as a formula to copy, but as a framework to think within. To Graham, the greatest success was not financial wealth, it was mental independence, the ability to remain unmoved when others panic, and untempted when others boast. And this method, built nearly a century ago, remains the most practical defense for today's investors in a world dominated by algorithms, speculation, and short-term noise. Because while technology has changed the pace of markets, it has not changed the nature of human behavior. Fear and greed remain constants, and so Graham's method, built on reason and restraint, remains timeless. Nearly a century has passed since Benjamin Graham wrote Security Analysis and The Intelligent Investor. The world he knew of ticker tapes and newspaper quotes has been replaced by algorithms, real-time trading apps, and financial media that never sleeps. And yet, for all the change in form, the essence of the market remains hauntingly familiar. Human behavior, the very thing Graham sought to understand and protect investors from, has not evolved. We still chase what is rising, fear what is falling, and confuse price with value. Today, the average investor carries a supercomputer in his pocket. He has instant access to financial statements, breaking news, and analyst opinions. But what Graham would ask is, has this made you wiser, or simply noisier? In modern markets, Graham's formula, his way of thinking, becomes not outdated, but indispensable, because it acts as a filter through the noise. It helps you distinguish between information and insight, between motion and meaning. If Graham were alive today, he wouldn't compete with algorithms. He would teach you how to think beyond them. He'd remind you that technology magnifies both intelligence and folly, that the real advantage in a data-driven age is not access to information, but the discipline to interpret it wisely.
Imagine Graham looking at today's markets. Meme stocks soaring on viral posts. Speculative manias built on promises of boundless growth. Traders calling themselves investors, and investors behaving like gamblers. He would smile, not with cynicism, but with calm recognition. Because he'd seen it all before. The names have changed. GameStop instead of RCA, crypto instead of gold mines. but the psychology is identical. In his time, he saw sure things collapse into ruin, and boring businesses quietly compound into fortunes. To apply Graham's formula today is to reverse the crowd's logic. When others trade on stories, you trade on substance. When others seek excitement, you seek evidence. When others ask, what could go right? You ask, what could go wrong, and can I survive it? That is how Graham's ideas live on, not in spreadsheets, but in behavior. He would tell you that an intelligent investor in 2025 must possess the same virtues as in 1925. Patience when others are restless, discipline when others are reckless, and skepticism when others are euphoric. Even his principle of margin of safety is more relevant than ever. In a world of inflated valuations and speculative optimism, the idea of demanding a cushion between price and value is no longer conservative, it is revolutionary. And perhaps most timeless of all is his insight that the investor's results are determined less by the market's behavior than by his own. Because even in a world of AI, algorithms, and instant trades, the one variable that remains outside automation is temperament. Graham's true formula, logic over emotion, discipline over impulse, value over price, remains the most dependable advantage an investor can have. It cannot be disrupted, it cannot be replaced, and it cannot be downloaded. At its core, Benjamin Graham's philosophy is not about money, it is about mindset. His teachings were never meant only for analysts or fund managers. They were written for anyone seeking to think independently in a world ruled by emotion. He understood that the principles that make one an intelligent investor are the same principles that make one an intelligent human being. Graham's formula, if we can call it that, rests upon three timeless virtues: logic, humility, and self-control. Logic, because investing begins with reason. An investor must seek truth from facts, not comfort from opinions. Every decision must stand on analysis, not emotion, not fashion, not fear. In Graham's world, knowledge was not power unless it was used rationally. Humility, because even the most intelligent analysis can be wrong. The market is larger than any individual mind, and the future will always hold surprises. That's why Graham built his entire approach around the margin of safety. It was, at its heart, an act of humility, an admission that we cannot know everything, so we must leave room for error. And finally, self-control, because without emotional discipline, logic and humility are powerless. In times of mania, when prices soar and crowds cheer, the rational mind is hardest to maintain. And in times of panic, when screens bleed red, the instinct to sell becomes almost irresistible. To master oneself, Graham taught, is to master the market. He wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." A sentence so simple yet so complete that it could summarize his entire philosophy. What Graham offered was not just a way to invest, it was a way to live. To be guided by evidence, not emotion. To seek value where others see fashion. To move deliberately in a world addicted to speed. And beneath his calm rationality was a profound moral view of investing. He believed that speculation, though thrilling, often degraded judgment, while investing, done properly, elevated it. Because true investing demands honesty, patience, and restraint, qualities that shape both portfolios and character.
Even Warren Buffett, Graham's most famous student, has said that what he learned from Graham went far beyond stocks. It was a philosophy of temperament, to stay rational when others are rash, to find joy not in market victory, but in intellectual clarity. And that, perhaps, is the greatest paradox of Graham's legacy, that his formula, born from financial markets, became a philosophy for life. Because markets will change, valuations, trends, even definitions of value, but the human struggle between reason and emotion will never end. And so, Graham's wisdom endures not as a method of analysis, but as a guide to the inner life of every rational investor. In the end, Benjamin Graham's greatest lesson was not how to find bargains, but how to find balance. He taught that investing is not a race, but a discipline, a long conversation between your capital and your character. Markets will always tempt you with shortcuts, but every shortcut leads away from understanding. The true formula for investment success, the one Graham devoted his life to teaching, cannot be written on a spreadsheet. It must be lived. It is the formula of rationality over emotion, analysis over impulse, principle over prediction. It is the understanding that wealth built slowly through patience and prudence is infinitely more stable than wealth built suddenly through speculation. And it is the quiet confidence that comes from knowing that you don't need to outsmart the market. You only need to outlast your own impulses. Graham once wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." That single line carries the weight of his entire philosophy. In the short term, emotion and popularity drive prices, but in the long term, truth prevails. Value is weighed. Substance endures. To follow Graham is to align yourself with the weighing machine, to place your trust not in noise, but in value, not in prediction, but in patience. It means seeing the market not as a battlefield, but as a teacher. Each rise and fall becomes a lesson in human behavior, each mistake a step toward greater wisdom. And perhaps that is the real secret. For Graham, investing was never about beating others, it was about mastering yourself. It was about thinking clearly in a world that rewards reaction and remaining calm in a system built on chaos. That mindset, not a formula, not a ratio, is what separates the intelligent investor from the speculative crowd. So the next time you open a financial app or watch a market headline, pause for a moment. Ask yourself, am I acting out of reason or emotion? Am I following principle or the crowd? That simple act of reflection is the essence of Graham's timeless wisdom. Because once you learn to think like an investor, calmly, independently, and rationally, you've already won the hardest battle. Nearly a century after Benjamin Graham's first writings, his ideas remain unshaken, not because the market stood still, but because human nature did not change. The faces, tools, and tickers have evolved, but the challenge of remaining rational in an emotional world remains the same. That is why this channel exists, to preserve, share, and apply the timeless lessons of the father of value investing. If you found value in today's exploration, consider subscribing to Benjamin Graham Value Insights, where together we continue the quiet pursuit of reason in a world of noise. Because wisdom, like value, compounds over time, and the first step toward it is to think for yourself.